Are you new to property investing? Well, if you are, then there are some key metrics that it's important for you to learn early on. Number one is being able to research a property to calculate its market value. Number two is being able to calculate a property's monthly cash flow. And number three is being able to calculate and work out the return on investment. And in this video, I'm going to be covering numbers 2 and number 3, which is cash flow and ROI. So first of all, what is cash flow? Well, in property, cash flow is the net amount of money that you earn from a property once that rent has come in, once all of your expenses have been deducted. So if that's cash flow, well, what is return on investment? Well, return on investment is actually your net profit, so the total amount of money you make from the rent minus the expenses, divided by the costs of your investment, so the amount of money that you put into that specific deal. And once you do the net profit divided by the cost of investment, that gives you your ROI percentage. And in this video, we are going to cover exactly that. We're actually going to take a specific property example and we're going to work out how to calculate the acquisition costs, so the money that we're investing into the deal. We're then going to work out how to calculate the cash flow and then take the two and work out the return on investment. So here is our example that we are going to be working through. Now, first things first, list price. Let's assume that we found a property and that this was listed for £135,000, but we have not paid £135,000 for it. We have agreed to buy it at £120,000. So a nice little discount there. It's sitting on the market and we're going to buy this as a turnkey property and rent it out. Now, if we have a 25% deposit, that's going to be a £30,000 deposit that we need to put down. Our stamp duty is going to be about £3,600 because that's 3% at this purchase price. We're then going to, of course, have our more typical buying fees, which for example will be solicitor at say £1,500, broker, so that'd be a mortgage broker, at £500, a survey might also be £500. We want to get a survey to check that the house is in good and fit condition. And let's, for argument's sake, that we actually even paid a sourcing fee on this one. So we've got a property sourcer to go out and find the property for us. And last but not least is the works, okay? So let's say that we are buying this off of a homeowner and they've been living at the property, keeping it in great condition, but what they won't have got it done is ready to rent out. So we just need to go in, maybe spend a bit of money on sort of basic health and safety things, maybe put in some fire alarms, a CO2 alarm, maybe even pay for the EICR, which is the electrical certificate that we'll need, or gas safety certificate. So then if we total all of those things up, our investment into this property is about £39,600. That's how much we're putting in to buy it, which is all the money from here down. So deposit and costs downwards. If we then look at the mortgage, because we're buying this, it's ready to go, we need to put a mortgage on this property. We know we put 25% down as our deposit. So now we need to work out the 75% loan to value mortgage, LTVM, loan to value mortgage. Well, the mortgage is going to be 90,000. Okay, that's the 75%. We might then have an arrangement fee, which is about 3% at the time of recording list. Let's say that that's the example, 3%, so £2,700. And we might have an interest rate of about 5%, also reflective of the time that we're recording this. If I then work out what 5% is of 90,000 plus our arrangement fee, because that will have been added to the debt, so 5% of £92,700, that is going to give us our total costs per annum. That's how much interest we're going to be paying per annum, because this is an interest only mortgage, which is £4,635, and that is what we're going to use to work out our monthly mortgage rate. So let's say the property rents for £850, which would be a fair rent in comparison to the purchase price. This mortgage amount broken down over 12 months is £386. We're going to have a managing agent costs of 12%, which is 10% plus the VAT. That's coming in at about £102. Oof, that's hefty. Insurance of £30. And then let's arguably say that there's maintenance or voids, an allowance that we put aside for that. which I think is fair to say they're going to come up, so we should probably put an allowance aside. So I've done 5% there. Some people like to do 7 or 10%. That's going to give us a profit margin of £289.25 to be exact, per month. That is per month. If we take that and we do obviously the calculation to make that per annum, obviously we're timesing it by 12, we're going to be left with £3,471 profit per annum, which is a good profit margin. Now, here's where the magic happens. We're here for return on investment, and that is what we're going to be focusing on. But before I even go into the return on investment, it's incredibly important for me to mention gross yield, because along your journey as an investor, you are going to hear the term yield thrown around a lot. And it's not completely non-void, okay? I do dislike it, but it's not completely non-void. But the calculation is worked out as the purchase price and the annual rent. So if we take £850, we times it by 12, we get our annual rent, and then we divide that by the purchase price, we're going to get our yield, our gross yield, which is 8.5%. What an estate agent will love to do is say, God, look how high that gross yield is. What a great yield, almost 10%, although it's 8.5%. But it's almost 10% gross yield. But what the yield and the gross yield will not tell you is, well, what is the profit margin? Okay, yes, the rent is 850 times 12, but what about all these expenses that are going to be variables? It's not going to tell you about what the interest cost was. So how do you compare this property against one that has a 3% interest rate when this one's a 5%? You can't. You can't compare in the good or the bad markets, because this is just a very dull key metric, and it's not anything that we should be going off of. We should not be making financial decisions off of this. Yet a lot of estate agents will try to lead you into doing so. But we are smarter, better property investors, and therefore we go off of return on investment. Okay, we're going to work out what money we get back in exchange for the money that we put in. So this is what we're here for, and this is what we'll now work out. So we take that annual profit margin of £3,471 and we divide that by the amount of capital that we put into this deal, which was all of these costs here. So we take all that profit and we divide it by all of those costs, and that will give us an 8.77% ROI. Okay, that's the return on our investment. And actually, these two numbers are relatively similar in this deal, but actually I've seen many, many deals where the gross yield might be 8.5%, but actually the return on investment is 40+%, because perhaps the profit per annum is really good and the amount of money left in the deal, the amount of capital put into the deal was very low. And of course, with return on investment, it's all about how high can we make this number, how low can we make this number, and that is why you could have a big difference between the return on investment and the gross yield. And that, ladies and gentlemen, is how we need to be thinking about property. We need to be thinking about facts, not feelings. We need to make sure that we do not get emotionally attached to properties, but instead we do due diligence on the area. We do due diligence on the house to make sure that we're not buying something that's going to be a pit of money. But then we need to make sure we do due diligence on our numbers. We need to make sure that this stacks up right with what we're trying to achieve. Now, this isn't actually particularly that much of an amazing deal. 8% return on investment really doesn't get me that excited. And the large reason behind that is because of the total amount of money we're having to put in, but also because of the current interest rate that we've used here as well. Whereas perhaps if we weren't putting in so much capital, or perhaps if this was a 3 or 4% interest rate, then of course the profit per annum versus the amount of money we put in then suddenly starts to outweigh, again, that profit being a lot higher than obviously the investment, which we want as low as possible, meaning the ROI would be higher, I'd be more excited, everyone is really happy. And that is it, ladies and gents. That is exactly how you should be calculating your return on investment. Thank you for watching, and I will see you in the next video.